Okay, can everyone hear me? I think I've been unmuted. This is Serge LeVert-Chiasson. I'm here with a number of guests to participate in CAFIID's first webinar. I want to thank everyone for joining. Before we get into the actual webinar, I'd like to ask Catherine from Deloitte to walk us through a little bit of the logistical update and how the webinar will work. And then I will go through some introductory comments and we'll go straight through to a brief presentation by Crystalus and Portico Advisors, followed by a Q&A. So over to you, Catherine, for a little bit of logistical instructions to help the participants in today's call.
Yes, thanks, Serge, and hello, everyone. Thanks for joining. So I'm Catherine from Deloitte, and I'm just helping facilitate this session and with all these logistics. So as you've noticed, I've muted everyone, so if you're able to stay muted during the presentation, that would be fantastic, just so that everyone can clearly hear. And if you have any questions, please hold off on to the end and you can ask your questions, and there'll be a session or a period of time where we can ask questions and have a bit of a Q&A. If you do have any questions going through and you want to type them in the chat box so you don't forget, feel free to do that and I'll keep track of them, and at the end we'll make sure that they get covered. And to unmute yourself or to mute yourself, it should be the bottom of your screen. There's a little microphone, so you should have that option there. And Serge, I'll send it back over to you. I'll unmute you. There you go. You should be able to.
Great. Yes, thank you, Catherine. It's a force of habit to mute myself after I speak, and apologies for that. So thanks again, Catherine, for giving us an update on the logistics. And even before I start, I want to thank Deloitte Canada, Ted and Catherine in particular, for offering their Skype for Business facility for today's call and helping us with the logistics, including some preparatory meetings that occurred prior to today. So really appreciate your time and effort there. So before we get to the presentation itself, just wanted to give a quick intro to today's webinar, but also CAFIID itself, because for some of you this may be a relatively new association you've heard of through the grapevine. I want to thank everyone for joining today's first webinar for the Canada Forum for Impact Investment Development Association. I also wanted to quickly introduce CAFIID, myself, the panelists, and the USAID funded research project in order to sort of put things into context. This panel is being recorded, so just wanted to advise all of you of that. Many of you had indicated interest in today's webinar but couldn't make it. Therefore, we're going to record it and put it in a member-only part of the CAFIID website after today's call so that you can watch it, share it, and hopefully learn from it as well. So just a bit about CAFIID first. CAFIID stands for Canada Forum for Impact Investment and Development. It is a volunteer-led industry association whose mission is to act as a platform for members to learn, share, collaborate, and act as a collective voice to strengthen the value and the volume of impact investment in developing countries. Its vision is to advance Canada's contributions and flows of capital towards impact investment in developing countries, creating more sustainable and equitable communities. We currently have the support of over 35 members, and I want to list those. I don't think I'll do it for every webinar, but I think it's important that we recognize some of the founding members, some of which are on the call, including the Aga Khan Charitable Foundation, CIDP, Convergence, Coraziao, Crystalus, Dalberg Advisors, Deetkin Impact, Desjardins International, DKM Foundation, E.T. Jackson Associates, Evolysis, Finca Canada, Grand Challenges Canada, Impact Capitalist, Inofi, Dr. Kevin McQuaid of Cape Breton University, Marigold Capital, Mars Impact Center, the MasterCard Foundation, MEDA, Moonspire Social Ventures, Oiko Credit Canada, Purpose Capital, Renew, Sarona, Solar Ear, Ted Rogers School of Management, Think Renewables, UBC Impact Center, the University of Guelph International Development Program, Van City Community Investment Bank, World Vision Canada, and WUSC. So this is a pretty long list, and I think it speaks volumes to the interest that there is out there from various parts of the Canadian society. And we're truly blessed to have such a great list of founding members, and encourage others who might be participating in today's call or contacts you may be having in the industry that are interested in the mission and vision of the association to join us. And I'm available by email or through the CAFIID website if there's any interest there. CAFIID this year has also an exciting lineup of webinars and events that our volunteers, our 3 volunteer-led committees are planning. So I'd encourage you to stay tuned. We'll be sending more information about those as they get organized. Before we move to the panel, I would like to also thank current and past board members, steering committee members, founders, committee members who have helped us to get this far. And they've contributed a lot of time and effort for the betterment of the industry and the creation of this association. So I really wanted to thank them and those that supported us as we got off the ground. So now I am your host and moderator for today's panel. I also happen to have the privilege and honor of chairing the CAFIID board. My name, as I introduced myself at the beginning, is Serge LeVert-Chiasson. I'm one of the founding partners of Sarona Asset Management, a Canadian and Dutch-based impact investment asset manager with a focus in private debt and private equity in developing countries. We also have an advisory business where we help organizations like MEDA manage their impact investments, and also put together some pretty interesting projects for blended finance and impact investments with donor agencies like USAID, GAC, and just recently we're working on something with the Australian government as well. We manage around $270 million Canadian investments for our investors and impact and partners. And for the panel today, so we'll go through the panel and then I'll just give you a very brief introduction to what the work was. So Patrick Brean will be delivering the introductory comments on the research. He delivers three decades of expertise in international structure finance, combined with hands-on advisory for innovative development finance projects and programs. Some of his clients include donor agencies, multilateral development banks, development finance institutions, fund managers, and foundations, including Sarona. So we're very happy to work with him on a few projects. Patrick is a recognized thought leader in blended finance and has advised public and private sector clients on numerous groundbreaking blended finance initiatives totaling over $5 billion. Prior to establishing Crystalus, Patrick held senior management positions at major public and private corporations, including Export Development Canada. Deborah Brean, who works with Patrick and is also married to Patrick, working for Crystalus, will be presenting as well. She specializes in development international finance with 2 decades of experience in deal execution, management, advisory. She's held numerous senior positions with the World Bank's International Finance Corporation, IFC, for those of you liking the shorter names, Export Development Canada, and the Federation of Canadian Municipalities. Advisory assignments include Global Affairs Canada, Green Municipal Fund, EDC, Inter-American Development Bank, Islamic Development Bank, and the Caribbean Development Bank. Deborah has closed on more than $1 billion in transactions around the globe and has delivered training workshops to government agencies, investment funds, and international financial institutions. And the final speaker today is Mike Casey. He's the founder and managing director of Portico Advisors, a research-driven private markets advisory firm that serves investors active in Africa, Asia, Eastern Europe, and Latin America. Before creating Portico, Mike co-founded the consulting service business unit at Empea, which he undertook engagements for firms stewarding more than $50 billion in AUM. Prior to Empea, Mike advised private equity, sovereign wealth, hedge fund, and corporate clients in investments in more than 20 countries. Mike has also had a very, in my opinion, one of the better monthly newsletters out there, and I read it with great interest. Many others do as well. So again, if folks are interested in receiving that newsletter, which I find very instructive on what's happening in the industry, I know Mike would be happy to add you to the list, and he'll provide some context information towards the end. Just before we pass it over to Pat for the presentation, just a bit about the USAID project. This USAID project was funded back in January of 2016 by USAID's Private Capital and Micro Enterprise Office. They had put a call for proposal for global partners to help catalyze institutional capital into developing countries. From that call for proposal, they received 53 entries, of which only 2 were funded. One of those projects that was funded was indeed the project we'll be talking about today. It was entitled Expanding Institutional Investor Capital into Emerging Markets via Currency Risk Mitigation, and it had 3 components, including a broad market survey, ideation with potential solution pathways on hedging FX risk for private equity, followed by a final report providing insights into next steps and implementation of some of these ideas. The next 30 minutes will be spent going through that presentation and spending a bit of time on Q&A at the end to tap into the knowledge of Pat, Deborah, and Mike. This panel, again, is being recorded and will be placed on the member-only part of the CAFIID website after today's session in case you want to listen in or share some of the insights that you may have heard today. So without further ado, I'm going to pass the presentation over to Pat to go through some of his introductory slides and hope that we solicit some ideas and future collaboration opportunities as well amongst the members.
Thanks very much, Serge, and good afternoon, everyone. It's a real pleasure to be here this afternoon and participate in this webinar. I want to give an overview of the project, along with Deborah and Mike, the key findings, and some of the key themes that emerged out of it that we think are very important. This is going to be a very high-level summary of what we did project-wise. I would encourage you to read our full report, which I believe was circulated to everybody, which provides a lot more technical detail and much greater context for a lot of the points that we will cover today. We will also reference certain sections of the full report as we go through the presentation and point you to where you can find additional information if you wish. So, in terms of project objectives, very simply it was to identify and develop new ways to help reduce currency risk for private equity investors active in emerging markets. If you can solve some of this problem, if you can take away even a bit of this currency risk for investors, you can get a lot more money flowing into developing countries for private sector development and sustainable growth. As Serge mentioned, the project was sponsored by USAID, by their private capital markets group. USAID kind of really took this issue to heart, and they understand that these development goals that the development community shares can only be reached by unlocking more private sector investment, more private sector capital into these developing countries, and that government funding alone, directly or indirectly, is not going to nearly address these needs. The project was led by Sarona, as Serge highlighted. Sarona is a global impact player in this space, and they have a lot of experience investing private equity across the developing world. And I think at the same time, Serge would agree that they know firsthand how hard it is to get private investors to put money into their funds. And a lot of this is due to real or imagined fears of currency risk in these markets. The other partners that were involved is Emerging Market Private Equity Association. This is the largest association of its kind in the impact investment space and represents members managing around $5 trillion worth of investments into developing countries in the form of private equity. And their membership strongly agrees that currency risk is a really big issue that has to be addressed in this space. As well, Portico Advisors and Mike Casey heads up a firm of private equity research specialists. And ourselves, Crystalus, just in a nutshell, we specialize in development finance and the risk management aspects around that. So just a few comments on why this project is so important. Everyone, I'm sure, on the call is familiar with the UN Sustainable Development Goals, and everyone agrees that it's very important to work to achieving these SDGs by 2030. The problem is that it's going to cost a lot of money. It's going to require a lot of investment. Estimates range around $4 trillion a year. But right now there's a massive shortfall in the funding for these SDGs of around $2.6 trillion a year. And government funding, as substantial as it is, through entities like USAID and Global Affairs Canada, and also through development finance institutions and multilateral development banks, there's a lot of substantial capital that's going in from government funding, but it's not nearly sufficient. So private investors need to be encouraged to invest more. And it's worth noting that the money is there. It is there. It's there with institutional investors and other large capital pools, but it needs to be unlocked. It needs to be encouraged to flow more openly into these markets. And so a lot of this money simply remains firmly on the sidelines. And a lot of this, again, is due to these investors' fear over currency risk. When we talk about currency risk for the purposes of this presentation and our report, in a nutshell, it's the fear that investors will have, whether that's a real fear or an imagined fear, that an investor's return in an emerging market will be effectively washed away because the emerging market currency will lose its relative value to a hard currency like US dollars or euros over time. Just at the bottom of that slide, we just highlighted the focus on private equity for this project rather than debt going into these markets. And you can imagine for a small business, a small enterprise in a developing country, debt's very important. It can provide a lot of much needed money for a business. However, equity, in this case private equity, provides funding, but it also provides a lot more. Equity investors and fund managers like Sarona and others in this space tend to play a very hands-on role, a very hand-holding role. And they do a lot of things that help benefit these companies that investors tend not to play nearly as large a role. In areas like helping improve governance standards, helping to make industry connections, both regionally and internationally, helping introduce best practices, etc. Another important point is that equity capital is very patient capital for these businesses that are trying to grow and they're trying to hire people and they're trying to make new industry connections. With equity, unlike with loans, there's no fixed repayment schedules. Businesses have breathing room. They can take the time that they need to grow and to flourish. Finally, many developing countries are quite overburdened with debt, so private equity helps to rebalance a lot of this burden. So we asked ourselves very early on, there's a lot of existing currency products that are out there, so why don't they work well for private equity? As we noted, private equity investors would put a lot more money into developing countries if they could protect themselves better against currency risk. It's a big inhibitor. And there are a lot of existing products that are currently in the market to protect people in the market against currency risks. So it begs the question, which we tried to address very early on in our project, why aren't private equity investors using these products? And the simplest way of saying it's because these existing products, things like currency swaps and forwards and that type of thing, are designed and have traditionally been developed to help protect people that are making loans. With a loan, you know when you're going to be putting your money out the door, you know when you're going to be getting your money back, there's an interest repayment schedule and a principal repayment schedule, and you know how much you're going to get back. But with private equity, this is a much, much harder thing to estimate in terms of timing and amount of cash flows. You don't know when, or you don't even know if you're going to get your money back from an investment. And even if you do get your money back from your investment, you're not sure when you're going to get it back, and you're certainly not sure how much you're going to get back. That makes it very hard, and in some cases it can increase costs to use existing currency risk products.
I think it's important just to highlight here, it's Deborah speaking, that when we first were speaking with industry participants about this problem, there is a perception that, you know, you look at any of the investment bank reports, JP Morgan or Chase, that publish, you know, substantial and deep long tenor currency, direct currency hedges, as Pat mentioned, swaps and options and forwards and collars. And there was a perception out there that this equity, private equity currency problem is already being, you know, effectively managed by existing products. And it was quite, I think, enlightening during the course of this work and you can see the graphic at the bottom of the page that we're on right now, page 4 of the presentation, is that really to articulate very clearly why existing products actually don't work. And Mike will speak to this later with all the Empea members' responses to the survey. And Pat mentioned the biggest one is that for all of the products, direct hedging products, except for options, the ones which are used in the market, swaps and forwards and collars, they all have a delivery obligation at the end of their term. So if you transplant a product like that to the private equity space, you know, you would have to go potentially to your investors and say, sorry, you know, you guys have to pay $10 million here for me to wind up this swap, even though I never exited my equity investment. So it ends up being a fatal flaw. That delivery risk aspect is a very important fatal flaw that we spent quite some time articulating and then making sure that the various product proposals we looked at and advanced didn't have these features that would be fatal for private equity investors.
So as Deborah mentioned, I mean, there are some products that are available in the market that do give more flexibility on when and how much you have to pay for the currency protection, things like, as she mentioned, currency options and that type of thing. The problem is that in theory, these products could work well for equity, but in a lot of these products are not available in many developing country currencies, or if they are available, they're available for very, very short periods of time, and they can be very expensive.
And a key consideration here was, again, you could search for an option they're available for reals or for rupees, some of the bigger currencies, even smaller currencies. But when you get into the most exotic, they're not available, or they're available very costly. And the reason for that, again, I think was helpful to highlight, is because any kind of direct currency hedge is always going to be priced on factors including this persistent differential in interest rates between the local market and the developed market, so say the US or somewhere in Europe. You're always going to have, as long as that country is risky and developing and their local markets are still evolving, you're always going to have that very high interest rate differential, which is what results in the fact that these direct hedging products, even where they are appropriate, like options, are going to be extremely expensive and limited. So, you know, does that local currency bond market, does it have tenors that are sufficient and so on? So that's actually the one reason why one of the products that we chose to develop the furthest in this project actually got around that entire interest rate differential problem, which we'll get to.
So quickly on our approach and our guiding principles for this project. I mean, there were two main guiding principles. One, don't reinvent the wheel. There are a lot of smart people, there are a lot of good ideas out there, and so our design was to build off existing thinking, existing products, and existing approaches. We also made a concerted effort throughout the project to engage widely and to engage often. A lot of the challenges we found as we got into this project was simply to build awareness and understanding and clarify some misconceptions about why currency risk for private equity needs these new solutions. I've listed on the slide a lot of the types of entities that we consulted with, all of the main stakeholders that touch this market: private equity investors, fund managers, industry associations, even possible new entrants into this space like insurers and brokers, and of course development finance players, hedging entities, currency hedging entities, donor agencies, and others. We up front, early on, did a detailed survey of Empea members. Mike will talk about that in a moment, to get their detailed input on what a solution should look like. We went out with an RFP as broadly as possible, given the budget limitations of the project, to seek out some of the best and brightest new ideas to address this problem. And we identified and refined several promising product ideas, and we ended up test marketing these ideas with investors and with fund managers to get their feedback into what worked and what didn't work. And then we ended up piloting one of these promising solution ideas called a proxy hedge, and we'll talk about that a little bit more, against actual emerging market private equity portfolios on a backtesting approach. So on that note, I'd like to turn it over, Mike, to you, Mike Casey from Portico Advisors. Mike will talk a little bit about the outreach activities that we did during the course of this project with private equity investors and with fund managers. And these engagements throughout the project were extremely important in not just identifying and helping hone in on possible solution ideas, but developing and refining them so that we, could say that and have confidence that we were developing ideas that would have resonance with actual market practitioners. Mike, I'll hand it to you.
Great. Thanks, Pat. So as Pat mentioned, engagement with practitioners was really core to this effort. And we knew as we got started, based on prior research and a prior survey that Empea conducted, very few investors hedged in emerging markets private equity, and that's whether they're a fund manager or an institutional investor. We also knew that currency risk was a real problem. So 60% of the respondents to Empea's first currency survey, which was conducted in 2016, reported that exchange rate movements had subtracted value from their existing investments, with several reporting losses in excess of $500 million or more. However, to develop innovative new solutions, we really needed to get a better idea of practitioners' needs in terms of what a product would actually look like. So we had to conduct a new survey. and we did this in January of 2017. And after cleaning up the data, we tallied 119 responses. And about 70% of those came from fund managers, and 30% came from institutional investors, the latter of which being the stewards of capital that policymakers wish to mobilize to achieve the Sustainable Development Goals. So within that institutional investor segment, we had a mix of development finance institutions such as EDC in Canada, or IFC with the World Bank Group, or CDC Group PLC in the UK. It's an acronym soup, so I'm sure you're familiar with all of them. But we also had private sector investors such as fund of funds, pension funds, endowments, foundations, and family offices. And as you can see from the charts on this slide, our respondents represent a globally diversified sample, and we got responses from investors that are active in each emerging market region. So we were pretty jazzed up about that. Pat, we can move on to the next slide. Terrific. So this is a busy slide, but I will try to walk through this sequentially so that it'll make a little bit more sense and be easier on the eyes. We had three key objectives with this survey. We wanted to verify that demand exists for new hedging capacity. We wanted to ascertain a detailed understanding of practitioners' current use of hedging products. And we wanted to identify the key characteristics of what an ideal hedging product would look like. And so first, the survey revealed that indeed 70% of commercial investors would have an increased appetite for investing in new or frontier markets if they had access to a cost-effective hedge. So the demand is there. Second, there was broad agreement that hedging is important, yet it is rarely done. So for example, 85% of the fund managers that we surveyed believe that hedging during the holding period of one of their investments is important. However, only 14% of them have done so. So this spoke to a clear gap in the market in terms of existing products not being fit for purpose for long-term equity investment. And then third, we wanted to collect the data that could assist with product development. And here we focused on 5 key variables: the user or ideal customer, the product features, the coverage breadth, the complexity of the product, and the all-important variable of price. And it turns out that the primary customer that we identified through this process was private equity fund managers. And it's not simply because we had more respondents who were fund managers. In fact, institutional investors also thought that fund managers were predominantly the prime customers for a hedging product. The second one that we identified was that the product would protect against extreme currency movements rather than, say, locking in a fixed exchange rate. For those familiar with options, it effectively means a put option strategy. And then on average, or rather on the coverage, 85% of respondents preferred a partial hedge. So they weren't looking to cover their full exposure to currency risk, but just enough to tip the balance in their favor. On the question of complexity, opinions were really mixed depending on the size of the firm, but as a general rule, opinions favored something a little bit easier, so insurance or insurance-like products. And then finally, on price, respondents were very price sensitive, and 75% of the respondents came in with a request for a price that would cost, say, 5% of their returns per year or less. Now, these variables were included in the RFP that we sent out to the best and the brightest who could respond. And you know, as Pat mentioned, the project team, we constantly referred back to these detailed survey findings as we worked with the proponents on product development and as we were working on refinements to those very products. So I think that does it for this slide, Pat. We can move on to the next one. Perfect. So Pat's going to discuss the solutions beginning on the next slide, but just to underscore our commitment to finding practical solutions for industry practitioners and institutional investors, we subsequently ran focus groups to test each of the products. And so this slide shows the firms that participated in these discussions. And you can see that they represent a blend of fund managers, institutional investors, and of course Sarona as a fund-to-fund, which neatly sits in between both of those two constituencies. And in addition to the type of investor, they're also active in each emerging market region. So some represent, more local funds, and some are regional funds, and some are global investors. And we also have firms that are investing in companies from the microfinance scale all the way up to large cap leveraged buyouts. When it comes to the institutional investor segment, we've got a development finance institution, an insurance company, and the World Bank's pension plan, which, even though it's part of a multilateral organization, the pension fund is actually much more aligned with a commercial investor that you'd see in the institutional investment landscape. So we were fortunate to build up a holistic view of industry demands and concerns throughout the survey and the focus groups, and their opinions were really key to this entire project as we brought it to fruition. So I think that does it for me. Pat, I'll return it back to you.
Thank you very much, Mike. And let's move to the next slide. Oops. Okay, so we want to move to the results that we achieved. And this lays it out in high-level form. We've got some additional information in the annex, and then I would really encourage you to dig into any further technical details in our full report. We identified 3 high-potential solution pathways, and within those solution pathways, we identified several new product ideas. One pathway was to use existing currency risk products already in the market, but to use them in new ways. And that gave rise to two product ideas, one called covertures and one called supported range forwards. So that's one stream. Another stream or pathway was to use existing low-cost financial products available in the market, particularly options, to create currency protection, but indirect currency protection. And that was a product called proxy hedge. And then thirdly, the third pathway was to use an evolution of an insurance product to cover currency losses on a portfolio of investments.
So the graphic that you see at the bottom of this slide, as Pat said, it actually was intended to capture the many, many innovative new ideas that came out from our RFP. So 1, 2, 3, 4, 6 baskets of ideas, if you will. The first one on the left, there were a lot of solutions provided from hedging funds, for example, or hedge providers about using rolling options or rolling forwards or things like that. There were some interesting ideas like asset liability matching and structured solutions. But as Pat said, the three that we felt had the greatest promise for development at scale, relatively commercial, not requiring massive amounts of development support, and other factors like we mentioned earlier, which would avoid any of the pitfalls like delivery risks, were the three in the middle there. And I think I'd like to point everybody for a moment to slide 16, where we'll give a brief outline of what those three product areas are that we advanced through this project. So if everyone is on page 16, as Pat mentioned, the first set of product solutions, two solutions, were proposed building off of existing direct currency hedges that are already in the market, but using them in innovative ways. So this slide actually compares all the new product ideas that we advanced, and it tries to compare them across similar metrics. So what does the product cost? What is the effective first loss that an investor would have to suffer on a currency loss before the coverage kicks in? And what type of coverage does that product provide? So if we take a first look at covertures, which is a solution that was proposed, what was new about this particular product is that it would effectively work as a hybrid between a forward and an option. So you would get, the investor would get the pricing of a forward, which is lower, but wouldn't have the delivery obligations of a forward. So these type of things have been used before, but the innovation here was that the company we worked with, MFX Solutions, would actually benefit from its sister company, TCX, who provides forwards in almost all the exotic and difficult markets. We've got a slide, a chart in the report on page 31 about all of the forwards that can be provided in which markets. There's Zambia, 15 years, Nigeria, 13 years, Namibia, etc. So effectively, without incurring a delivery obligation, a private equity investor could get their Nigeria Naira covered for 13 years on a certain basis. So that's a real product innovation. The downside is the cost. You can see very, very costly, 3 to 12% per annum on an example we used, which was, I think, Brazilian real. So that's of interest to, let's say, an equity investor, private equity investor, perhaps in Africa, and maybe they have one investor who absolutely has to have the Nigerian Naira covered. The second solution proposed by MFX on the direct hedging side is a supported range forward. And that was innovative in the sense that by using an agency support to cover some delivery risks, you can see the price to the investors much lower. Instead of 3 to 12% per year, it would be around 1% per year. The downside of a supported range forward would be it's only going to be available in countries where options are available, so the better developing countries. So those two solutions, as we talked about before, still rely on the depth of local currency capital markets and still are priced off of those interest rate differentials. So those are some persistent problems. If we move to the middle solution, which is the proxy portfolio, the interesting thing about this, as we mentioned earlier, is it completely disassociates from that interest rate differential, costing of the interest rate differential. So instead of having to price a direct currency hedge, the idea of a portfolio of proxy hedges is that a risk management company, in this case Validus, would purchase a series of very, very liquid North American options, like options on oil or gold or wheat or interest rates or equity indices, which would then be crafted to move up in value as the local currencies moved down in value. So the idea of a proxy hedge is not new, but how it was applied in this case was new. The fact that the components in the hedge would never give rise to a liability for an investor was very, very important. And the degree of very complicated econometric modeling and scenario analysis, picking appropriate hedges, determining the appropriate deltas, and so on, gave rise to a very, very interesting product, which was back-tested on many scenarios, including 2 actual portfolios. So if we compare the cost of the proxy hedge approach, you can see the cost is fairly reasonable, 1 to 3% per year. The first loss for an investor that they would suffer maybe 6 to 7% per year. And then the coverage is really quite substantial, up to 70% per year. So the interesting, I think the overall interesting aspect of the proxy is that it acts very much like an insurance. It covers a lot of the things that Mike was talking about, where it would cover higher levels of depreciation, the cost point is good, etc. The downside of the proxy is that the cover is probabilistic in nature. It's not certain. And then finally, the insurance approach. There was a huge amount of interest in an insurance approach to this problem, given how insurance is well understood, its ease of administration. Insurance is already provided for political risk, for example, but currently the insurance providers don't cover devaluation risk. The proposed terms look, as you can see there, potentially 2% per year. The investor would suffer quite a hit, 5% or so per year, and then the coverage they would receive after that would be fairly small, 5%. We didn't pursue the insurance extensively because the market is not ready for that. The appetite from reinsurers and insurers is not there at the moment. So really that doesn't have a near-term application. In summary, those were the 3 product areas that we looked at, the proxy hedge having been advanced to the greatest degree, and please do consult the report for all the details.
Thank you, Deborah. I note that we're slightly eating into our time on the Q&A, so I'll just go over the last 2 slides very quickly, and if people have questions on them, we can go further. We've noted some themes that emerged from our work throughout the project. And so just to note there, I mean, this isn't a problem that's going away anytime soon. And the private equity community through Empea and through other sources as well. I mean, everyone's calling very loud and clear for new thinking and new solutions in this space. The second point is that by virtue of this project, largely, I think there's a lot more focus and a lot more players that are coming to the table with a lot of ideas. I think from the commercial side, private sector side, and hedging entities and other players in this market, they see a large untapped potential market. We've put a guesstimate of a market size there, 40 billion, 50 billion. This isn't being addressed right now, so I think a lot of people are willing to roll up their sleeves and put some time and effort into thinking about solutions. The third point, very important, and certainly from a blended finance point of view, development agencies, donor agencies, the USAID, the Global Affairs Canada, and others of the world, they can play a role, an important role, with respect to risk capacity and participation in helping drive new solutions into the market. This is a very new market. These are very new ideas. These are prototype ideas. And some risks and some costs will be too much for the private sector to bear completely on their own. So how do you get these ideas, ready for prime time, fully commercialized? And there's going to be some assistance needed to get there. Finally, going forward, we were very strong in our final report, and USAID was in tremendous agreement that this report is not an end; it's a starting point of a longer pathway to build on this momentum that's generated, to spread the word, and to communicate as broadly as possible. So we've had a fairly aggressive, very aggressive dissemination plan, both directly with people sharing our report and also working through associations like yourselves. The most important thing that could possibly come out of this is to find opportunities to demonstrate these or other product ideas that are now coming out of the woodwork on a demonstration basis in real-time, real-life investment and fund management situations. And so that seems to be like a logical next step. With that, Serge, I'll hand it back to you for Q&A.
Great. Thanks to Pat, Deborah, and Mike for enlightening us a little bit and summarizing, I think, a 60-plus report in less than half an hour. Very appreciative. I'm going to open it up to Q&A. The only thing I'll ask for those of you asking questions, if you could just state your name and your organization just to help with the flow of conversation, that would be great. And I might ask Catherine if you could unmute everybody's line. That's probably the easiest thing to do, and then people can ask their questions.
Yep, everyone should be unmuted now. So again, you need to unmute yourself to be able to ask a question, and that is the little microphone button at the bottom.
Yes, right. Good. Okay. Any questions from those attending?
This is Stephanie Aymon from Think Canada. Thanks, everyone. This was really, really interesting. I have a question about going forward. Any concrete next steps and keen interest from funders to bring this to the next level?
Thank you for that. As I said right at the end of our remarks, to me, that's the logical next step, and it's going to take a concerted effort. I think the private sector players, and certainly those that were engaged in developing product ideas for this project, are really keen to try to test these ideas out in, as I say, real life, real time situations. I think what this project has done is identified some ideas. There are going to be other good ideas out there in the market, and we've succeeded in taking these ideas through a proof of concept stage. And then one of the ideas, the proxy hedge, through a pilot or a feasibility stage. So the next logical sequence is to start demonstrating these things in the market. And I think that's going to take the concerted effort, not just of willing private sector partners, but the development community is going to have to step up to the plate somehow, some of them, whether it's on a bilateral or a multilateral basis, and say, this is a problem we want to help support and find a solution for, and we're willing to share some of the costs and the risks.
Just a note to CAFIID members here, that might be an interesting project for CAFIID.
Yeah, that's a good point. And thank you, Stefan. Any other questions from those attending?
Pat, I'm not sure if you're able to see Carrie's question there. It looks like his audio is not working, so he's posted a question in the chat box.
Oh, okay.
I can read it for you, Pat, if you want, if you wish. The question is, can you clarify to what extent we are hearing from investors who are already engaged to some degree or another in investing in emerging markets, as opposed to investors who are not yet convinced to take that plunge, i.e. currency risk, the most significant impediment to getting new players onto the field? Oh, that's a good question. I'm wondering if maybe Pat and Mike can tackle that one, because I know, Mike, you've been involved in a lot of conversations with different people.
Maybe I can just say, I think there's a couple of things here. Currency risk is a big risk for people. I think it's, Mike will correct me if I'm wrong, second behind political risk in terms of getting more capital flowing into these markets. And I think the problem is twofold. One, it's to get people who are already investing in these markets to invest more, to unlock their wallets wider. And then to get those who just are too fearful of the risks in these markets, likely smaller, less sophisticated investors, to help encourage them to get into the market and experience what it's like and how these risks can be managed. Mike, you might have additional details.
Yeah, I think that's a great point. And so when you look at the findings from this survey and the other surveys that Pat just mentioned, which are Empea's LP surveys, limited partner institutional investor surveys, those are predominantly investors that are already looking or investing in emerging markets. And so to these investors, it is the case that currency risk is an inhibitor to either further capital deployment or entering into new markets where the currency risk is just taking it beyond their risk return thresholds. The second piece to your question is what's the role of currency risk in terms of keeping money on the sidelines? And I think it's a question of, it certainly is playing a role. However, there are other impediments as well in terms of, the number of fund managers. Are they institutional quality? Can they get access to the right companies and investments in these markets? So I think it is a richer story, but, this project came about because currency risk is a very real problem. And, just to give one example, there was a fund manager based in an emerging market. It was a country dedicated manager that tried to solve this currency risk problem for their investors because they were facing a depreciation in the local currency that was basically diluting all of their returns in dollars. And so the fund was no longer going to be able to distribute carried interest, basically the profits from the investments back to the institutional investors. That fund manager took out some currency hedges, but they moved against the fund manager, and the fund ended up going bust simply from the expense of the hedges. And so it's a very real problem. There are body bags, for lack of a better term, in the industry because of it, and so it is very germane to many players.
Thanks, Mike. I did have a question from Ted Thomas, who I don't think is on the call right now, but sent a question in advance of today's. So I'll read it out loud and see if one of you is interested in tackling it. Ted asked, I would be interested to dig further into the nexus between public sector, catalytic finance, and private investment in these instruments. In other words, what are the blended finance opportunities? Did your research uncover any models that were particularly good and had some early and innovative potential for implementation?
I think that's a really good point, Serge. And I think just kind of generally, there are really important opportunities from a blended finance perspective to help bring these ideas, these fledgling ideas to market. And these are still very early days in developing solutions. And private sector solution providers do need help sharing these costs and these risks. As a practical example, and one thing that came up during the course of our project some of these product ideas that we've looked at, like proxy hedging, for example, require the investor and or the fund manager to be making upfront cash payments to put this protection in place, even though the protection will kick in over time, over many years, maybe 5, 6, 7, 8 years of the life of a fund. So carrying these upfront costs that you have to pay for the protection over the life of a private equity fund will really depress the overall returns. So an example of an intervention, a blended finance intervention, for example, could be a development agency helping to finance these upfront costs, helping to defer them via line of credit, other things, so that you can help fix these cash flow timing mismatches.
I think the other thing to mention there is, it would seem readily obvious as to why wouldn't a development agency just put in place a big trust fund and put money into it to directly defray currency risks for private equity investors. And certainly that would be lovely. The problem is that, of course, that solution is not scalable. It would require more money than is available. There are other ways that development agencies or other public sector support can be brought to bear to catalyze some of these and de-risk some of these approaches that we've talked about. Pat mentioned one, and it also explains why the solutions that we looked at and advanced, one of the criteria for looking at them was their potential for scalability and effectively commercial viability. Although, as you'll see in the report, some of the solutions do require upfront a little bit of agency support.
All right, thank you, Deborah. I see we're at the top of the hour. I really want to thank all of you who attended the call, and more importantly, thank Deloitte for hosting the call, and the panelists for providing such an interesting conversation on how to hedge a very difficult product to hedge. And the hope is some of this conversation will have stimulated some ideas with you, and hopefully we can, as Stephanie mentioned, see how the CAFIID can learn, share, and collaborate towards a viable solution, as many of us would love to have a solution to hedge against some of these investments in these developing countries, which are difficult to do so with today's products in the market. So thanks again, and looking forward to seeing all of you and perhaps more of you at the next webinar, which will likely happen in April. We'll send you some more information, and we'll be focusing on impact measurement with the help of FINCA and the MasterCard Foundation, as well as a few other speakers and moderators. Thanks so much, and have a great afternoon.